Welcome to this first lecture of week 5. The presentation will focus on government accounting and finance. We will examine the following financial tools: the balance sheet and the income statement. The balance sheet shows the financial standing of an organization at a particular time. Its date is normally the end of the accounting period, which may be monthly, quarterly, or yearly. In written notation, the balance sheet appears as follows: asset equals liabilities plus owner's equity or fund equity. It is important to note that asset represent what the organization owns, and cash is a defining asset, as all other assets are categorized according to how quickly they can be converted into cash. The asset side of the balance sheet is thus divided into asset and long-term assets. Current assets are relatively easily transferable into cash and include the cash account, marketable securities, accounts receivables, and inventories. Long-term assets include land, building, and machinery. They are not intended to be converted into cash, but instead they are used in the process of generating cash. On the other hand, liabilities and owner's equity, also called fund equity in the case of public institutions, represent the sources of income used to support the asset side of the balance sheet. It is therefore necessary that both sides of the assets equal the liabilities and owner's fund equity. Coming to income statement, we need to note that the balance sheet shows the financial standing of the organization at a specific point in time, whereas the income statement depicts the income earned by the organization over a period of time. The balance sheet and income statement are related, as the balance sheet shows how much income generating potential the organization has, while the income statement shows what income was generated with the asset and debts shown on the book of the organization, as you can see from this table. In short, the income statement shows revenues, less expenses, and the net result or income of that calculation. Thank you.